Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: since April 2020, overseas companies with UK rental income are taxed under corporation tax, not income tax. Today is about the admin engine room of UK R&D tax relief claims, not the science test and not what counts as eligible R&D. This is the practical reality, where the claim sits in the corporation tax return, the deadlines, the extra forms, and the rules that can make a claim invalid even if the company genuinely did qualifying work. We'll also cover how R&D interacts with other reliefs, and the anti-avoidance rules that can switch relief off if arrangements are mainly about getting a tax outcome. An R&D tax relief claim is made through the corporation tax self-assessment process. That means the claim is included in the company's corporation tax return. A claim can be made in the original filed return or through an amended return. So R&D relief isn't a separate application in the way some people imagine. It lives inside the return process, and that means deadlines and filing rules matter. There are different time limits depending on when the accounting period begins. For accounting periods beginning before 1st of April 2023, the R&D claim deadline is generally tied to the corporation tax return filing date, and the claim generally must be made by the first anniversary of that filing date. For accounting periods beginning on or after 1st of April 2023, the deadline is generally within 2 years of the end of the period of account on which the return is based. If the period of account is longer than 18 months, the time limit can be 42 months from the start of the period of account. In limited cases, HMRC can allow the deadline to be extended. The practical point is simple. Even if the work qualifies, a late claim can fail because the deadline wasn't met. Sometimes a company makes a claim under one scheme, and later it's found the company wasn't eligible for that scheme. In certain post-April 2023 cases, where an SME claim is withdrawn, there can be a short window to submit an RDEC claim instead, after the amendment removing the original relief is issued, or after an appeal is finally determined. The system contains switching mechanics, but the time window can be tight. For certain types of R&D relief, HMRC requires extra return pages. Companies claiming RDEC and SME payable tax credits are required to submit the CT 600L supplementary page alongside the corporation tax return. Even if the numbers are right, missing required pages can create avoidable compliance problems. For accounting periods beginning on or after 1st April 2023, there is also a claim notification requirement that can apply. Unless an exception applies, the company must notify HMRC of its intention to claim within 6 months from the end of the relevant period of account. If the notification is not made in time, the R&D claim is treated as invalid. Exceptions can apply, for example, if the company has claimed in a recent 3-year look-back period, or where another claim or notification covers accounting periods in the same period of account. For claims made from 8th of August 2023, an R&D claim is treated as invalid unless it is supported by an additional information form submitted on or before the date the claim is made. This applies regardless of which accounting period the claim relates to. If the company fails to do this, HMRC can remove the claim from the return. The additional information form requires structured information, including company details, senior internal R&D contacts, the accounting period being claimed, breakdowns of qualifying expenditure, and project-level information based on how many projects are included in the claim. Even where only some projects are described, the company must retain records to support all projects. If an R&D claim was overstated or wrong, and the company can't amend the return because the time limit has passed, there is a voluntary disclosure route designed to correct errors and settle what is owed, including tax, interest, and potentially penalties. There is also an advance assurance concept for smaller companies. A targeted pilot was announced for spring 2026, allowing assurance on specified aspects before submitting claims. Even where assurance is obtained, administrative requirements still apply. There are anti-avoidance rules that can disregard R&D claims to the extent arrangements are entered into, wholly or mainly for a disqualifying purpose, such as obtaining relief the company wouldn't otherwise be entitled to. RDEC can also interact unexpectedly with quarterly installment payments because it is included in taxable profits, but operates as a credit rather than a deduction. R&D can interact with patent box and creative sector reliefs, and overlapping claims can be restricted at project or expenditure level. And this brings us back to the fact we opened with. Big tax switches can happen based on a single date. R&D is similar. A claim can succeed or fail based on timing rules, forms, and deadlines, not just whether the work itself was genuine. I told my accountant a joke about depreciation. It lost value over time. This content is for general educational purposes only. It is not tax advice. Tax rules can change, and outcomes depend on individual circumstances.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.